Welcome, everybody, to the Momentous Wealth Podcast, where we discuss current issues in the world of finance and break them down into understandable terms to further your education. Momentous Wealth Management is a financial planning and investment management firm based in Washington. We've been serving clients for more than 20 years, and on this show, we take that experience and put it to the microphone in an effort to educate investors in the complex world of finance and financial markets. Hello, everyone, and welcome to another episode of the Momentous Wealth Podcast. We're filming this one.
Yeah. Should we say hi to the video people?
Yeah. Hello, video. So
welcome.
Yeah, this is our first episode that's also going out on YouTube. Hopefully.
Yeah.
Yeah. We know the audio is working. We're sampling the video.
So if you're driving in your car, keep listening. Don't switch to YouTube.
Exactly. We're gonna delve into a pretty interesting topic today. There's a lot going on in the world right now.
Yeah.
As you may or may not know.
It's the first time too that a lot has happened in the world.
Exactly. So today's episode is all about addressing a lot of the things in the news today. We're going to address some things individually, but also just as a whole. So the reason we're talking about this is because it's not abnormal. Like, we often get questions from clients when there's stuff going on in the news, right? I mean, so it is not abnormal. I think one of the things that people, I don't know, maybe one misconception right now is the fact that I think people think there's a lot more weird stuff going on now than there normally is. Mm-hmm. And that may or may not be true, just kind of depending upon what you think about the world and what your viewpoint is. And as you can tell, we're going to try very hard to
Be apolitical.
Yeah, exactly.
Yeah.
Because, we have clients that are all across the board, and our job is to serve them and really try to look through what's going on in the political environment and really help figure out what's best from an investment perspective. But, we are getting a lot of questions right now from clients, and it's not uncommon for us to get an email from a client, or have something come up in a meeting where it's just like, hey, with all this crazy stuff going on, how in the world can my account be doing well? Because with all the stuff that's happened this year, I mean, we've had tariffs. We've got stuff going on with the Fed.
Yeah. Potential interest rate changes. We've got the potential government shutdown looming. That comes up every year.
We've had wars.
Yeah, we bombed Iran.
Yeah. The debt. I mean, the debt's always in the news. We had a new tax plan announced.
Yeah.
So tons of stuff. And with all that going on, I mean, and this data is through, I guess it's according to Yahoo Finance, because that's who runs our iPhones, right? Who tells us when you look at your iPhone, isn't it Yahoo Finance that powers?
Oh man, I don't know.
Yeah. Okay.
It's so funny. When I hear Yahoo, I'm like, they're still around.
Oh, well, according to the app on your iPhone,
the finance app
on your iPhone, because we have to cite where our sources are from. As of today, so we're recording this on September 3rd, the S&P 500 is up 9.4% year to date.
Yeah.
For 2025.
If I'm being honest, I didn't use the finance app. I just Googled SP 500.
Okay.
So according to Google.
Yeah. Okay. So with everything going on right now, right? Like, we got a ton of stuff in the news. We got, a lot of stuff going on in politics. How is the market up 9.4%? Like, that's what we're going to get into.
Yeah.
We're going to talk in generality, just how markets work, because I do think it's important when you have a lot of crazy stuff going on in the world. I think today's episode is important because, the answers we're going to give today tend to be the answers
most of the time.
Exactly. So we're going to use some examples of what's going on in the world today, but also talk more long term. So we're going to talk in general about why the market is up 9.4% year to date.
Yeah.
With everything going on. And then we're also at the end going to get into some specifics to use as examples, right? So at the end, we're going to get into kind of what's going on with the Fed and this idea that we might cut interest rates, but also one of the things that's a little bit abnormal right now is that the Fed is getting a lot of pressure from the president.
Yeah.
So that is something going on. So we're going to get into that. And then at the end, we're also going to talk about tariffs. So I think this is perfect because depending upon where you're at with tariffs, maybe you're sick of hearing about tariffs, maybe you're not. We just got an announcement recently that one of the courts potentially said that the tariffs are illegal.
Yeah.
And then it's going to
don't
go
spoil
to
too much.
Supreme
We'll
Court.
get to it.
Yeah,
We'll get to it. Yeah.
So if you're sick of hearing about tariffs, we're going to hold that off to the end, and you can just turn it off when we get into tariffs. But if you want to hear more about tariffs, then listen to the end.
Yeah.
Okay?
Great.
Yeah. Perfect. So here we go. So first thing we're going to do is just dive into, again, the general thinking of like with all this stuff going on, especially in the political world, why is the market going up?
Yeah.
So
I think the first and most important thing to remember is that markets, it's not that they're apolitical. It's not that they don't care about politics, but their priorities are often a little bit different than the politics. They're not going to be moving lock and step in the same movements, in the same movement as politics are announced at a media level. And there's a lot of reasons for that, but investors aren't necessarily watching, CNN, Fox, CNBC, waiting for the news to break and then restructuring their portfolios, making sells and buys. Yeah. They're focused on so many different elements.
Yeah.
Politics are a piece of, or an ingredient of the pie, but they're not their entire piece. Yeah. So are investors watching that? Yes, of course, but they're also looking at things like, where do we think long-term trends are going? What are the fundamentals of these companies? And so they're not just looking at one piece.
Yeah.
And I think that's the most important thing to remember in all of this is that we're going to individually feel a lot more of the emotional movements of the markets or the politics than the stock market is going to feel.
Yeah. I think you made, lots of good points there, Nick, but the two things that I think about often and that I talk to clients a lot about is the fact that, like you said, there are hundreds, if not thousands of factors that go into what drives the market. And, politics is one of those things, but it's one of hundreds or thousands of factors.
Yeah.
Right. So, and like you said, and I think you bring up a really good point, is the fact that for a lot of our clients, they don't really care about politics, but a lot do, right? And, what's interesting too is like right now, if you're someone who voted for President Trump, then, you might be overall happy with what's going on right now. And actually the political climate would make you feel better about things. But if you're someone who maybe didn't vote that way, then, obviously you're not feeling good about things right now, right? And that's an emotional thing. Yeah. So no matter what side you're on, it's very emotional the way that we feel about politics and just kind of the overall world in general. And the thing is that I will say, like, from our experience is it seems like with every election, when we flip back and forth between Democrat, Republican, whatever, it's just like we go through the same things, right? Because I'll just say that, like, when President Biden was in office, it was a different segment of our clients that were happy versus sad. Yeah. Right. Yeah. And so that's what's always really interesting about politics is that it is very emotional because we feel it, right? No matter what side you're on, you're either going to be really happy or really sad. Or again, maybe you're kind of in the middle and you don't really care all that much about it. But yeah, it's one of a million factors. Yeah. Right. Yeah. So, but because it's emotional, it tends to kind of go to the top and make us feel a certain way, even though the market is less emotional. It's just looking at the numbers, right?
Yeah. It's one of the things that we tell our clients often, and you've heard it before if you listen to other financial advisors or analysts or investors, that the more that you can detract your own emotion from your portfolio and the world, the better of an investor that you'll be. You know, some of the best investors are people that they completely forgot that they had investments, and they get a statement in the mail, or they're like, oh yeah, I got a Bitcoin sitting in a landfill somewhere, landfill, you know, and it's like, yeah, because you didn't let your emotions dictate what you should do with your investments, because the investments, they're not necessarily only concentrating on the news segment. Yeah.
And if we move a little bit away even from politics and just talk about world events, right? Because there's always stuff going on, you know, like right now there's a lot of political stuff in the news, but at other times it's not. It might just be, you know, COVID is a good example, or when wars happen, things like that. A lot of times people are surprised by a really major world event happening and surprised by the fact that the market doesn't necessarily react to it.
Yeah.
And the way that I often think about these things is, and I think actually, like, you know, COVID was a little bit of an example of this, but if you think about it in terms of there's stuff that goes on in the world, right? So we might turn on our TV and we might hear about a political thing or just some world event, and it might be really happy, sad, whatever, and we're like expecting the market to act a certain way, right? But at the end of the day, markets move based on, so again, in the short term, markets might move based on news a little bit here and there, but long-term markets are going to move based on corporate profits, right? We're investing in corporations, and at the end of the day, it's the profitability of those companies that matter. And so oftentimes, if you're an investor, what can work really well is just to think about, is this thing happening going to affect the way that you live your life, right? So I always use Starbucks as an example. Like, there might be some big world event going on, but at the end of the day, if I'm still going to wake up, you know, eat breakfast, take my medication, get in my car, go to work, hit Starbucks on the way, like, then at the end of the day, that event going on might not impact the market, because if I'm if it's not stopping me from buying my Starbucks, then that world event is not going to affect Starbucks profits, and therefore it's not going to affect the stock price. Right? And so I mentioned COVID. Like, COVID was interesting because it was like, oh, here's an event that actually did
affect everything.
Let's
like, shut down everything. And businesses corresponded correctly with world events of, like, we saw a big dip because the question was, how is this event going to allow us to sell coffees when you cannot leave your house? You know.
But it was short-lived.
Yeah.
And because guess what? Like, you're not going to keep me from getting my Starbucks for very long. So for a short period, the world shut down. But then even in that, we figured out a way around it, right? It was like, oh, we'll mobile order. Like, I can't go sit down and have coffee with Nick, but I can stop in with my mask and grab a coffee, or make it at home. Right? So
there's two forces on it. On one hand, I don't want to not buy my coffee. And on the other is, you don't want to not sell me that coffee.
Right.
You got to cut the consumer and the business person out for there to be a substantial change. And what we see often is it pivots. And I think you could take the tariffs, for example. And if we're using the Starbucks analogy, you might be like, well, their imported coffee is going to be more expensive. But, you know, maybe they pivot and they say, let's reduce our overhead to offset that cost. And so that big event, you know, it may not actually affect their bottom line revenues in the ways that we, as just a straight consumer, are gonna think.
Exactly. So really great points there. So to kind of land this plane and move on to the next topic, there's also, you know, those are some things to think about when you're thinking about, okay, is this world event going to affect my stock portfolio? And the answer is, again, think about it in terms of, well, is it going to change my daily behaviors? Now, again, like, some things do, right? Like, some things do change behaviors, or maybe they affect certain industries, right? So that's something you got to consider. But also, there's a lot of good stuff going on right now. So, like, to your point earlier, Nick, about the fact that the political climate, the stuff going on in the world, that's one of many factors, right? So there are some other factors going on right now on the positive side that are maybe overshadowing some of the just kind of the volatility we're seeing and uncertainty in political environment.
Yeah, and I don't even think it overshadows it from an emotional standpoint, but just from a large numbers standpoint. So in a lot of our podcasts, we've talked about how indexes and markets work, that as a company gets bigger, it's going to take up more of an index. And so, if you buy the S&P 500 with $500, it's not $1 to every 500 companies, but the bigger companies are going to eat up more of that, that $500. And so what we're seeing is these Mag 7 companies that are invested in AI have just been growing and growing and in positive ways with their development of AI. And so if we go back to Starbucks, they may have a bad day because of what's going on in the news, but if their market share of an index is significantly smaller than an AI, it's not really going to have a big ripple in the total economy. In AI, because it has been such a big shift and there is so much optimism around it, that a lot of times when we hear these things that are happening in the markets, it's like, yeah, that does have a significant effect in the economy or the labor force. The question that's important to ask is, how big of an impact is that going to have on the AI sector, because it's already dominating so much of the weight of the index. Right. So if you have 7 companies carrying, I think right now it's around 30%, unless those 7 companies are impacted directly by whatever's happening politically or in the world, you're likely not going to feel that as big of a swing emotionally as, what's going to actually hit AI's bottom line.
Right.
And there's so much optimism that investors, they may be like, yeah, that sucks. But I still think long-term, this is the place to go. They're probably not going to shift their portfolios.
So are you suggesting, Nick, that right now, again, we talk about the fact that there's a lot of factors that go into this, and there, whenever we look out at the world and try to predict what the market's going to do, it's like there's going to be some good and some bad. But one of the really good things right now, which is a really strong driving force, just continues to be the innovation around AI. Yeah. So that's a really good point, because it's good to mix in some positive.
Yeah.
And then I know one of the things when we were preparing for this, you talked about rate cuts too.
Yeah.
So talk to us about that, because that's another generally pretty big influence to the market. I do think that what the Fed does with interest rates, you'll often hear the term "don't fight the Fed," right? I do think there are certain things and factors in the market that do tend to be more impactful than others. And I think what the Fed does with interest rates, it doesn't guarantee anything, but Fed's decisions around interest rates tend to be one of the factors that does have a stronger impact than some of these other forces.
Yeah.
So what's going on with rates?
And I think the Fed is a good example of a really heightened political, emotional thing that we're going to hear about, because we're on the tail end of a lot of concentrated attention on the Fed, because interest rates and inflation have been such a hot topic that when the Fed comes up, it's like, oh, this is going to have a huge impact on the markets because it just did. But we also have to fight recency biases that, just because it was a big issue and you're hearing about it doesn't necessarily mean that it's going to have that same impact. And so at the end of the day, what the Fed's job is to make sure that the economy doesn't run too hot, inflation isn't going up and prices are soaring, but also that it doesn't slow down too much. And so one of the things the thing they have to control is interest rates. They get to decide how easy is it for businesses to get access to capital. And so there's a lot of conversation right now about if the Fed reduces interest rates, how's that going to affect the markets? And if we think about that, if capital becomes more cheap to acquire, then businesses are going to be able to expand and grow long-term a lot easier. And so on the short term, there's a lot of questions about, what if that raises inflation and consumers' money isn't able to go as far? How is that going to impact it? A lot of uncertainty. But again, if we go back to AI, if we reduce the cost to borrow and we tell these big AI companies, hey, these hundreds of billions that you're getting are going to become substantially cheaper now, then there's going to be even more money that's going to be funneled into the long-term growth. And that's where investors are often keeping their eye, is how are these decisions going to impact that long-term growth? On the short term, interest rate changes are going to affect things and, are going to cause some market change or stock market changes, like maybe up, maybe down. A lot of uncertainty, we don't know. But it could be that interest rates are going to unlock long-term growth. And so what we may be concerned on the short term, investors and AI developers, they may be like, we're not as concerned. We're not going to make huge shifts in our portfolio because what may be good or bad for you isn't necessarily as good or bad for us. They just work on a different plane than we do.
Yeah. Okay. So we got a lot of, again, we're making this cake, right? We're baking this cake. When you make a cake, there's a lot of different ingredients that go into the flavor of that cake. And we got some of the ingredients right now are these uncertain events around, tariffs, around, the debt, wars, all sorts of craziness. But then on the flip side, we have things like the excitement around AI, the Fed maybe cutting interest rates, which, as you just described, tends to have a, generally, historically has had a somewhat positive impact on stocks, right?
Yeah.
So those are some of the good things, right? So at the end of the day, it's like you have to factor all those things in, right? And that's why it just becomes so impossible. And we always talk to investors about, you got to be a long-term investor. It's really hard to time the market. If you look back at some of these years that we've had recently, we would have never expected the returns that we've seen in markets given some of the things that we've had, not only last year, but if we just go back the last few years, right?
Yeah.
And I think even COVID's a great example, right? Like if you would have told me at the beginning of 2020 that we were going to shut the world down, but hey, if you invest, you're going to make money because the markets were up in 2020. We had a lot of volatility, but markets made money. It just continues to prove that you can't time it, right? Like several years ago, we could have never have imagined the growth and the boom that we were going to see from AI.
Yeah.
Right. I mean, that's really, as you mentioned, been one of the main drivers of things over the last several years. So, I think that in summary, just realize as an investor that there's a lot of things that go into this cake.
Yeah.
Right.
And I think one thing too is that investors across the board and really large scale investors, institutional investors, I think are learning that unprecedented is more precedented in the fact that we can continue to things are going to happen that we didn't forecast. They're not going to pan out how we projected and thought they would. And I think what we're seeing is a lot of people saying, let's wait and see how this pans out. Yeah. Because I think Liberation Day with the tariffs was a really great one. Yeah. There wasn't a whole lot of movements prior to tariffs coming in. Yeah. Because, what's going to come out to be? How are they going to come in? When they were put into place, markets did not like that. They reacted quickly. But then when they kind of got pulled back, markets rebounded a little bit. There was still talks about tariffs, but they didn't respond as much because they were in this, well, let's wait and see. Yeah. Everything, we're in new territory here. And if they get too ahead of the gun, then they might be on the wrong side of the markets. Right. And so I think even investors are realizing, you know what? We shouldn't be trying to time these things. Even if something seems like it's going to affect us long term, let's wait before we make a portfolio change and see what actually sticks to the wall.
Well, that's a really good segue into the couple of examples that we want to get into, right? So, again, what we just did is kind of talked overall about how markets work. Yeah. But there's two specific examples that we want to get into. One, because we think that these are things that investors want to hear about right now. But two, I just think they're really good examples of how everything we just described works in real life. Okay, so the first one, I'm going to put you on the spot, Nick, because this is a little bit more of a hot button here.
Okay, great. Yeah.
But, you talked about interest rates and the Fed. But right now, one of the big things that we keep hearing about is how, the president seems to be more involved than usual with interest rates, right? We're seeing a lot of pressure placed on the Fed by the president to lower interest rates. We're seeing, at times we've heard threats of potentially firing the Fed chair. We know his term comes up early next year anyway. But that is one of the big things going on right now, right? Is you're seeing a lot of pressure from the president to try to, I guess, control the Fed a little bit more than normal.
Sure.
Right. So that's one of the things we wanted to get into as a specific, and then we'll talk about tariffs. So what's going on with that?
Yeah. Again, I'm not an economist, so there's going to be a lot smarter people having a lot more accurate views on this. But from what I've seen and gathered, the president is wanting interest rates to be cut a lot sooner than the Fed does.
Yeah.
The Fed's job, and we say Fed, we mean Federal Reserve. They're the central bank that's in charge of interest rates. Their job is to act as an independent agent outside of what politicians on Capitol Hill are going to do. That's what it's designed for, because they realized we need to make our economy run outside of the political games that happen at the highest level. And so we're seeing the president push that boundary and trying to influence the Fed to lower interest rates sooner than what the Fed is wanting.
Right.
I think we're at a point where the Fed is on the same page. Mm-hmm. Now, to how much the political pressure influenced that, we won't know.
Yeah.
But it's ultimately the Fed's job to take all the pieces of the pie, all the ingredients, and to make a call on where should interest rates be at, how fast or slow or not at all do we want to move interest rates.
And part of that too, I know the Fed is saying, hey, we because there's a lot of people right now too, not just the president, saying, hey, we think rates should be lower. A lot of economists and just market whatever, I don't even know what you call them, market people, the people that speculate about the market, the dudes and on CNBC,
the finance bros,
are like, oh, the Fed needs to cut rates, right? The Fed stance is they want to see what's going on with tariffs, right? They're, because they believe the Fed, their job is to keep unemployment low. They have a dual mandate to keep unemployment low, but also keep inflation low. And they constantly have to balance, because if they cut interest rates, it helps the economy typically, but it can also drive up inflation. And one of the big concerns right now is that, obviously we just came off of a period of really high inflation. And there's some concern that depending upon how the tariffs are implemented, that could increase inflation. And so what they don't want to do is have, the tariffs potentially causing inflation. And then also they come in and cut interest rates, which is another factor that can cause inflation. Because, I think they're probably a little bit gun shy just based on the period of time we just came out of with really high inflation, right? So they really want to make sure it's under control. So that's kind of the Fed stance is, the Fed, because the Fed is designed to be independent, right? And I think what's interesting about Jerome Powell is he was originally appointed to this position by President Trump in his first term. He was reappointed by Joe Biden. That's typical of Fed chairs. A lot of Fed chairs have served under many presidents and many different political parties, right? And so that's kind of the balance going on right now. Yeah. And you have, and then you have a lot of people that on the flip side are saying, hey, we think rates need to be lower. We are starting to see some signs that the economy is slowing down and inflation is under control. So they're looking at the Fed chair saying, hey, why don't you cut interest rates?
Yeah. I think too, an important thing on all of this is this topic that we're talking about of politics versus market movements. You don't want a Fed that's going to act too quick based on politics. If there's anybody in all of this, investors or whoever, that's going to play the slow road, you want it to be the Fed.
Right.
The last thing you want is a Fed that's like, should we cut interest rates? Yeah, let's do it. We don't know all the data, but we're just going to do it because I feel like we should. They're the one person that should be the adult in the room.
So that's the balance going on. And I think, again, when we were talking, you made a good point earlier, Nick, is I think what we're seeing, and again, I think this is an example. And the reason I wanted to bring this up as an example is because I think this is a really just good example of overall what's going on right now, right? Is you don't tend to see, the Fed's job is to be independent, as you said. Well, right now, what we're seeing play out is the fact that the way our system was designed is, sure, there have been threats to get rid of the Fed chair, but there's a process in place. Like, the president actually can't just do that, right? And so I think that what we're seeing right now is kind of just more evidence. The Fed is designed to be independent, and that's holding up, right? And so, we really see that with a lot of things right now, in the political world, which is like we have a system in place, right? We have Congress. We have 3 branches of government. We have the Supreme Court. I mean, all these things in place to kind of make sure that the system holds up. And I think that is what we're seeing is, the markets having confidence in that. Yeah. Right. In that these systems like the Fed right now is doing, who knows? People are always criticizing the Fed, right? Like they should do this, that, the other thing. Like, and again, I think that's another example we wanted to point out is the fact that for whatever reason, it's in the news more right now that people are like critical of the Fed. But like, I mean, personally, in the time I've been doing this as a job, I can't remember a time where like everybody always criticizes the Fed, right? Yeah. I mean, you go back just a few years ago when we had high inflation rates and all of a sudden everybody's like, oh yeah, see, they should have raised rates sooner, right? So like this idea of criticizing the Fed is not new. Yeah. And I think that's the other point that I wanted to bring up in this is, yes, what's going on right now is interesting, but also
interesting. Stupid joke.
Oh,
I'm sorry.
That was good.
That was bad.
That wasn't bad. Wow. But it's like, not to make light of it, but it's like war in the Middle East, right? It's like, well, yeah, okay. I mean, that happens quite a bit. There's a lot of, and I just think this idea of, the Fed has a tough job because they have this dual mandate, and it is just not abnormal in any way that you're going to have criticism of the Fed and what they're doing and if they should do this, that, or the other thing. I mean, everybody acts like they know more than the Fed chair. Yeah. Right?
Yeah. So, and even that idea of like acting on what is even such a hot topic right now, because how many times in the last couple months has data come out on the economy and the labor market only to get a big revision a little bit later had the Fed or anybody acted on that data. It's like, well, hard to know if that's the right call when everything is up in the air for, how concrete is that?
Yeah, exactly. Yeah. Okay. Anything else you want to talk about on the Fed?
Nope.
Okay. Well, let's get into our last topic today, which is tariffs. And I think, again, we're talking about this because, one, it's in the news again, because recently we just had a court decision saying that the tariffs, I don't know exactly how it was phrased, but that basically the president doesn't have the power to implement tariffs without the approval of Congress, and that the emergency act they used to do it didn't apply to this. President Trump has said he's appealing that ruling to the Supreme Court. And, we don't know what's going to happen, but I will say, like, most of the articles I've read kind of suggest that, the thinking at this point is like probably will be upheld. We don't know, but I don't think there's a lot of people at this point. I think the most common thought right now is that the tariffs somehow, some way will be upheld. Yeah. We don't know. But that's why we're talking about it now, is because it's back in the news again. And frankly, we didn't really talk about it before.
Because again, it was like,
Yeah.
we don't know where it's going to fall. We'll wait and see.
Yeah. So we're getting a lot of questions on it. Again, I think if you're like sick of hearing about tariffs, like, well, for one, tune out now.
Yeah. Thanks for joining us.
Yeah. Or just listen, because I think right now what's going on with tariffs, frankly, I think is the most prime example I can come up with of how like markets often don't react the way we think they should react.
Yep.
Okay. So real quick, I want to give a rundown of just like how these tariffs are working. Okay. So like, let's use an example, right? So there's a 25% tariff on Canada right now. Okay. And we're going to use this example of you want to buy maple syrup at Costco. So what I want to get into is like how the tariffs work, because I think there's a lot of confusion as to how they work, who pays the tariff, etc. Okay. So if you're Costco and you're importing maple syrup from Canada, let's just say that the maple syrup manufacturer charges Costco $20. Costco marks it up by $5 to cover their costs, and then you sell it to the end consumer at $25. Okay. Well, if there's a 25% tariff on Canada, that means the 25% tariff is going to be on the $20 that Costco is paying to the Canadian syrup manufacturer. So 25% of $20 is $5. Okay. So the company who legally has to pay the tariff is the importing company. So Costco. Yeah. Costco is the one that actually has to write the check to the government for this tariff because they brought in $20 of maple syrup from Canada. Okay. So if Costco is selling that syrup for $25, and again, in this example, that would basically be their entire profit margin.
Sure.
Right? They buy the syrup for $20, they sell it for $25, they have a $5 profit. Well, now the tariff they have to pay is $5. So who's going to eat that tariff, right? Like Costco can go to the maple syrup manufacturer and say, hey, you need to charge me less. They can do that. They can ask that, but they can't force them. Costco can decide that they'll just reduce their profit margin if they want. But in this case, if they reduce their profit margin by the amount of the tariff, they will make zero.
Yeah.
Or they can pass it on to the consumer, right? So those are kind of the three options for how these tariffs can be implemented. We have some actual examples of this, though, right? So under the first Trump administration, there was a 20% tariff placed on washing machines. Okay, so here's just an example. What we saw in the first Trump administration is, and I will say, this data that I'm giving you today, this is all from our friends at Dimensional Funds. So Dimensional Fund Advisors provided us a really great example and some history on the way these tariffs work. So that's where I'm getting all this data from right now. But the first time around, when these tariffs were implemented, the first time under the first Trump administration, what we saw is of this 20% tariff, about 12% of it was passed on to consumers. So the other 8% just kind of got absorbed and eaten and things like that. So here's one thing that's really important to understand. Companies will try to move around this, right? Like companies are smart. Companies, not all, but pretty much any major company that you're invested in, if you're invested in Apple, Microsoft, the S&P 500, right? They're all they're doing business around the world. They're used to navigating so many different political environments and tax environments and tariffs and whatnot that, for one, companies tend to find a way around this stuff, right? And figure it out. And that's what we saw happen the first time around. And so one of the things that we just want to make very clear is that tariffs, again, if we're using this example, because it's been one of the biggest things in the news this year. It's probably the biggest thing I can think of all the things we've talked about.
Yeah.
Tariffs are not the primary driver of performance. We keep going back to this, but it's one of many factors, right? So here, this is an example of how yes, this is a factor, but it's one of many. And what I'm going to provide you right now is actually some evidence that these things didn't impact the market the way that we think they would, right? And so let's go back to the first Trump administration. There were tariffs put in place the first time around, but they weren't as broad, right? But we have some very specific examples, okay? And I want to tell you right now, I'm rounding here, okay? You can go and you can look at the numbers on your own if you want. You can go to Yahoo Finance, or wherever. We have no, by the way, we have no affiliation with Yahoo Finance.
Yeah, that's right.
They're not paying us anything yet.
But if you wanted to,
yeah, Yahoo.
hit us up.
So again, this information is provided by Dimensional Fund investors, and we're rounding, okay? But the first time Trump was in office, again, there was talk of tariffs. The U.S. Steel was this U.S. company because there were tariffs placed on steel. So you would think if tariffs were the primary driver of performance and the Trump administration put tariffs on importing steel, that if any company was going to benefit from that, it would be U.S. Steel, right? Yeah. U.S. Steel, their price previous to Trump taking over had declined from around $40 to around $20 a share. Okay. When the talk of tariffs started happening, the price of U.S. steel went from around 20 back up to around 40. So when the tariffs were announced in 2018, in March of 2018, from that time until Trump left office the first time, the price of U.S. So once the tariffs actually were in place, because they went in place in March of 2018, over the next 2 years, the stock went back down to around $20. So if tariffs,
the U.S. steel stock
went down. So you would think that if tariffs were the primary driver of performance, that the price of U.S. steel, once tariffs were actually in place, would have gone up, when in reality the stock went down around, we're rounding, around 50%.
Yeah.
Okay. And then here's what's also interesting.
Well, do we know why that? Do you have any data on the other
because
why it went down?
Yeah, because of all the reasons we've talked about.
Sure. Yeah. There is not one. Yeah.
There's one of many factors. Yeah. Companies work around it. So the companies
internationally,
again, we're speculating. We don't know for sure, but the assumption would be that the price skyrocketed from 20 to 40 on the rumor of these tariffs, because the thinking in the market was that, oh, this is going to be amazing for U.S. steel. But then what we actually started to see unfold over the next couple of years is it didn't really do that much. That the other companies that make steel, they did the things they needed to do to kind of work around it.
Yeah.
Right? And so what we found is that it actually didn't have the impact on the companies that we were worried about.
Yeah.
Right? And so more examples of that. So the first time around, again, because there's been, I will say, like, from my perspective, like, there's been a lot of news stories this year, but I don't believe that any of them have gotten the notoriety that the tariffs have gotten, right? I mean, there's just all this tariffs. Okay. If tariffs were the primary driver of market performance, then this would not have happened. Because again, everybody's worried that these tariffs are going to, whatever,
grenade the entire economy.
During the first Trump administration, we had, again, to a lesser degree, but we had the same type of trade war. We had tariffs put in place, a lot of the same concerns. The S&P for the 4 years that Trump was in office the first time was up around 80%. So again, if tariffs were the primary driver of performance, we wouldn't have seen that, right? And here's another crazy stat. During the first Trump administration, the primary target for the tariffs was China. This time around, we're seeing tariffs placed more broadly. But the first time around, China was really who we were going after with these tariffs. So again, if tariffs were the primary driver of market performance, you would expect then maybe the target of the tariffs would be hurt. And again, this goes to your point of why did U.S. steel ultimately go down? Because it didn't have the impact that we thought. China's stock market, so during that time period where the U.S. market was up around 80%, China's market was up around 100%.
Wow.
So you would think that, again, if the tariffs were designed to hurt China, their market would have done poorly. Not only did it not do poorly, it actually did better than our market.
Yeah.
Right?
I mean, we kind of saw that at the beginning of this year with Liberation Day. I mean, I think we saw the tariffs were implemented.
Yeah.
U.S. markets didn't like that.
Yeah.
But international, the people who they were targeted towards, has crushed it.
Yeah. This happens all the time on our podcast, and people don't realize it. But Nick is psychic. I don't know if you know.
Oh yeah, I do.
Because we didn't go over, like when we were prepping for the show, I just told him that I had a rant on tariffs.
Yeah.
And
did I just steal your thunder?
I mean, right here's the evidence for the people on the okay. So yeah, that's exactly what I was about to say.
Yeah.
So again, we referenced earlier that through September 3rd of 2025, the S&P is up 9.4%. But there's some data that Dimensional Funds put together that is a little bit older. This is the first half of the year. Okay. So through the first half of the year, the S&P was up around 6%. So again, with all the tariff stuff, and I actually think that's a better number because that actually more encompasses the time that Liberation Day happened and all this craziness. But through the first half of the year, the S&P was up around 6%. Again, we're rounding, okay? So that's with tariffs. And again, you would expect that the companies like China, Canada, Mexico, that and Germany, because like Germany makes a ton of autos, and a lot of these tariffs were designed to kind of target some of these German car manufacturers, right? So again, you would think if tariffs are the primary driver of performance, the S&P 500 was up 6% with all that stuff going on. Well, like Nick just mentioned, China's market was up around 18% over that same time period. Canada was up 16%. Mexico was up around 30%. And Germany's market was up 35%.
Wild.
Yeah. So, again, I just think this is a really good example of like these things that happen that we think are just going to be the thing that moves the market over and over and over. We just have to continue to remember as investors that there are hundreds, if not thousands, of factors that implement the market that affect the market. And the thing that we're hearing about on the news that day, or the thing that maybe we're getting worked up about, while we don't want to downplay those things, like they're important things, and they might be things that you care about deeply that are very emotional to you. And we're not suggesting in any way that you shouldn't care about those things, or those things don't matter.
You just don't change your portfolio because of it.
Yeah.
Yep.
So what we are talking about is the portfolio, right?
Yeah.
And at the end of the day, what affects your portfolio is a lot of things.
Yeah.
Yeah. So
I think it was something that's came to mind as you're talking is I'm thinking like, why do we have such a connection with politics to our portfolio? And I have to imagine that there have been a few times when politics have correlated very highly with portfolio returns. Mm-hmm. You know, the .com bubble, when everyone, overhyped on how the internet was going to have an impact, the financial crisis and the housing market crash. It was both on the news and in the markets. And then with COVID, I think those three things, had a momentary correlation. But if you think about, were there other news stories that happened over the last 25 years yeah, there was a lot, but we tend to latch on to the ones that have the most blaring and obvious correlation. We just think, oh, that's going to be like that for everything. And the reality is it's like, no.
Yeah.
Have there been in the past? Yes.
Yeah.
Will there be news stories in the future that do correlate with markets? Yeah. But that's more of an anomaly than it is a like a principle.
Yeah. It's like we always, I feel like we end every podcast on, you can't time the markets.
Yeah.
And generally speaking, being diversified and being long-term in your approach tends to be the right move more times than not. And I think that, I'm someone that I don't, to me, as an investor, to me, like just hearing that over and over necessarily isn't really what I want to hear. It's not good enough. But when I see these examples like what we just went through, where it's like, oh, this is why, I think it's just a good reminder. And then it helps you, you're not just sticking to that plan blindly, but it's like, these are the reasons why, right? Because we can't, you can't guess it. No one knows the future, right?
Yeah.
And, like the market is the sum total of everybody's thinking on a certain thing. And, so like for everybody freaking out about a stock and not liking a stock or thinking that there's going to be disaster, for every person selling, there's someone on the other side buying, right? That's the market, and you have to have an equal amount of buyers and sellers, and that's what affects those prices. So, I mean, anyway, I just think it's fun to use real world examples of kind of why this stuff makes sense and why we give the advice that we do.
Yeah.
So,
and I think if you're an investor out there, meaning you've got money in a 401k or you got $1 million portfolio or whatever, if you ever find yourself thinking that you know better than the whole markets, where you want to make a bet on an individual stock or you want to make a decision based on a political thing that you hear, ask yourself the question, what could you possibly not know that everyone else does or doesn't know?
Yeah.
It's kind of crazy to think that any individual person is going to know what's going to happen in the future. So if you ever feel a tendency to make that decision, don't do it.
There you go.
Don't do it.
So the one thing we didn't get to is the debt. And so what I wanted to do is just tee that up. That's going to be our next episode.
Nice.
So the national debt and the situation going on there, it just requires a little bit more explanation. So we wanted to kind of stop there today. And then our next episode is going to be kind of on this same theme, but we're going to dive specifically into the debt and actually give some real world examples, kind of like we did with the tariffs. So anyway,
I wonder what the takeaway actions are going to be. What do I do as an investor because of the debt?
That's true. It'll be like one of those movies where they show you the ending first.
Yeah, that's right.
Yeah, but you don't know how they got there. So, yes. The answer is stay diversified.
Yep.
Stay long-term in your investment approach. So but we're going to explain how we got there.
We'll work it out.
Good point. All right. Thanks for joining us, everyone. The opinions expressed in this podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Momentous Wealth Management, Inc. is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Momentous Wealth Management, Inc. and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Momentous Wealth Management, Inc. unless a client service agreement is in place.